Imagine waking up to find your favorite burrito bowl, your go-to snack, and even your toothpaste all costing significantly more, all just because of one political decision. Welcome back to the Savviest Financial Minds on YouTube. And for those of you who don't know me, my name is Steven Spicer. And after more than 15 years helping clients with their investments, I am regularly in awe of the number of ways chaos enters the market and the number of variables involved. And we'll come back to that idea in a little bit, and how that stress and unpredictability generally is what led to my initial realization for myself, my clients, and those that I advise that we need to stop investing like they tell us. But first, we're pulling apart the economic mess stirred up by Trump's new Liberation Day tariffs, where everyday prices, corporate profits, and even global markets have buckled under the pressure.
Our country and its taxpayers have been ripped off for more than 50 years, but it is not going to happen anymore.
Let's dive in. On April 2nd, President Trump announced sweeping new tariffs, a 10% baseline tax on nearly all imports into the United States, with some categories, particularly goods from China, seeing rates spike up to 60%.
Using emergency powers, he's imposing a baseline tariff of 10% on imports from all countries.
Tariffs on Chinese electric vehicles doubled. Certain steel and aluminum products tripled. Consumer electronics from countries deemed unfair traders quadrupled. Trump's stated goal is to restore America's manufacturing dominance, arguing that decades of offshoring hollowed out the U.S. industrial base and made us dangerously dependent on foreign supply chains. And please note, this is not meant as political commentary. I'm not claiming something is right or wrong here, or to know what the best solutions going forward might be. My expertise is helping make sure my clients are protected, no matter what chaos comes our way. So understanding situations like this and their chaos-causing potential, that is in my job description. So anyway, if you've spent any time studying history, you know that tariffs don't always play out the way politicians hope. Back in 1930, Congress passed the Smoot-Hawley Tariff Act. The idea was similar: protect American jobs by taxing imports. The reality? U.S. exports plummeted. Retaliatory tariffs exploded around the world, and what could have been a garden variety recession snowballed into the Great Depression. Fast forward to today. Wall Street didn't wait long to vote with its feet. The S&P 500 dropped over 10% in just 2 trading days after the announcement, the steepest 2-day drop since March 2020 when the world shut down for COVID. And the sell-off wasn't limited to stocks. Treasury yields spiked as investors feared higher inflation. The dollar initially strengthened on safe haven flows, but by week's end it started to fall as global confidence in U.S. fiscal leadership weakened. Commodities like oil and copper, which are sensitive to global growth, plunged more than 8% over just a few sessions. But the pain doesn't stop at the trading floor. Companies are now scrambling to adjust. PepsiCo revised its earnings guidance lower, saying packaging costs, plastics, metals, labeling are up significantly. The CEO Ramon Laguarta warned that even ingredients like high fructose corn syrup, which is usually domestically produced but still affected by broader commodity markets, are under pressure. Chipotle, already struggling with rising beef prices, issued an even sharper warning. Tariffs on imported avocados, tomatoes, and packaging could squeeze margins and force them to hike menu prices. Chipotle CFO didn't mince words. Consumers should expect to see higher prices by late summer. Procter & Gamble, the household name behind brands like Tide, Pampers, and Crest, also cut forecasts. They said tariffs are driving up costs not just on raw materials, but on shipping, storage, and machinery needed to maintain production lines. It's a snowball effect. Higher input costs lead to lower margins, which leads to consumer prices being higher, which leads to weaker consumer spending, which leads to slower corporate profits, which leads to lower stock prices. Retailers are flashing warning signs too. Walmart's CFO said their suppliers are already requesting price increases across multiple categories.
But it's unavoidable that you're going to see some prices go up on certain items.
Target released a memo to vendors signaling they would consider strategic price adjustments throughout Q3. Translation? Get ready to pay more for everything from t-shirts to televisions. And the auto industry? They're practically begging for mercy. Ford, GM, and even Tesla have voiced concerns. The US doesn't make enough parts domestically to avoid import tariffs entirely. Everything from wiring harnesses to specialty batteries to semiconductors is imported, much of it from China, South Korea, or Germany. Ford's internal projections suggest that the average price of a new car could jump by $3,500 to $5,000 if tariffs persist throughout the year end. That's not pocket change. And the used car market, it'll feel it too. As new cars become more expensive, demand for used vehicles will spike, pushing those prices up right alongside them. Zooming out, the American consumer, the backbone of 70% of US GDP, is starting to sweat. The University of Michigan's Consumer Sentiment Index dropped to 62.7 in April. That's down from 68.4 just 3 months prior. That's a sharp move for a survey that normally changes by a point or two at a time. The Conference Board's Consumer Confidence Index also fell sharply, with expectations for future business conditions plunging by the most since mid-2022, when we were still digesting the aftershocks of runaway inflation. Penn Wharton budget model analysts estimate the Liberation Day tariffs could slice around $1.6 trillion off US GDP over the next decade. They're also projecting that the average American household could see an effective $2,500 tariff tax annually between higher prices and slower wage growth. And internationally, retaliations are escalating. China wasted no time slapping tariffs on $60 billion worth of US exports, targeting key political constituencies like agriculture, soybeans, pork, and manufacturing, aircraft parts, semiconductors. Beijing's strategy is clear: cause enough economic pain in swing states to shift political pressure back onto Washington. The European Union is considering emergency tariffs on US tech giants. That's right, companies like Apple, Google, and Amazon could find themselves paying new taxes to sell iPhones, ads, and cloud services across Europe. Canada and Mexico, America's closest trading partners, are warning of targeted countermeasures. Mexico's economy ministry said it's exploring proportional and reciprocal responses, while Canada's trade minister called the US moves an economic assault on our middle class. It's not just saber-rattling either. If retaliations spiral, some analysts fear a 20 to 30% drop in global trade volumes, similar to the contraction seen during the 2008-2009 financial crisis. And on top of all this, lawsuits are flying. Several multinational corporations and trade groups, ranging from the National Retail Federation to the American Automotive Policy Council, are challenging the tariffs in court. Their argument: Trump's use of emergency trade powers exceeds constitutional limits and represents an abuse of executive authority. That legal fight could take years to settle, though, but in the meantime, uncertainty will hang over business investment decisions. And politically, even some Republicans are squirming. Senator Rand Paul called the tariffs a crushing across-the-board tax on American consumers. Former Vice President Mike Pence, once Trump's loyal number 2, labeled it the largest peacetime tax hike in American history. And while Trump's base loves the America First messaging, polling shows that independents and suburban voters, critical swing blocs, are increasingly skeptical. A new Reuters Ipsos poll shows 57% of voters think the tariffs will hurt, not help, the economy. So what should you be doing right now? Well, of course, that all depends on your approach. If you followed me at all in the past, you know that I advise a non-traditional approach. I've detailed all that in our Financial Doomsday Survival Guide email series, link in the description. Specifically, if you're curious about non-traditional ways of investing directly into the market while being insulated from concerns like this, I'll share that with you here in a bit. But if you're still invested using that mainstream stock and bond only approach, as most people are, here are the things you should keep in mind or make sure your advisor is actually paying attention to. A thoughtfully, intelligently enhanced diversification is your best friend. Consider sectors that rely less on global supply chains. Think domestic energy, healthcare, utilities, and certain pockets of technology like cybersecurity. Commodities could also present interesting opportunities. Historically, during periods of inflationary trade wars, hard assets like gold and agricultural commodities have tended to outperform. And from the consumer side of things, awareness is key. Watch for price hikes. Lock in deals now on big ticket items like appliances or electronics if you're in the market. because 6 months from now, that 65-inch TV might cost you $200 more. And most importantly, stay nimble. The Liberation Day tariffs may just be the opening salvo in a larger global realignment. We could be witnessing the early stages of a new economic era, one defined by fractured trade alliances, localized manufacturing, and higher costs across the board. Or this could all blow over. That's kind of the point of my caution in general. There are so many variables at play. Just because the markets in the past have performed in a certain way, that is absolutely no guarantee as to how they will perform in the future, hence my book. Anyway, as promised, if you're curious about non-traditional ways of investing directly into the market while being insulated from concerns like all of this, this video will walk you through everything.